You've spent 15 years paying your mortgage. Every month, on time, no exceptions. You've repainted the kitchen, replaced the roof, watched your kids grow up in that house. It's yours. Fully, legally, undeniably yours. And then one morning, a letter arrives. It isn't from the bank. It isn't from a contractor. It's from a law firm you've never heard of, representing a person you've never met. And the letter says that actually your house might belong to them. You call your title insurance company, the one you paid a premium for when you bought the property, the one your agent told you would protect you from exactly this kind of nightmare. And the claims adjuster tells you something you will never forget. We're sorry, but your policy doesn't cover that. This isn't a hypothetical. This is happening right now in cities across the country as a wave of obscure legal loopholes, outdated policy language, and a property market transformed beyond recognition is exposing millions of homeowners to a risk they were told they'd already paid to eliminate. And the most dangerous part? Most victims never saw it coming because the industry designed it that way. Stay with me, because by the end of this video, you're going to understand something that most real estate agents, mortgage brokers, and even attorneys won't tell you straight. You're going to understand why the title insurance product sold to nearly every homebuyer in America is, for a growing class of modern threats, functionally worthless. To understand the trap, you have to understand the original promise. Title insurance was born out of a very real problem. In the 1800s, American property law was a mess. Land changed hands through informal agreements, handshake deals, and paper records stored in courthouse basements that flooded, burned, or simply disappeared. Fraudulent deeds were common. Forged signatures were common. Heirs of deceased landowners would appear out of nowhere, sometimes decades later, and challenge ownership with legitimate legal standing. Buyers had almost no protection. In 1876, a lawyer named Joshua Morris in Philadelphia had a client who purchased a property, received what appeared to be a clean title, and then watched helplessly as the courts handed that property to someone with a prior undisclosed claim. Morris's client lost everything, the property and the money. Morris founded what is considered the first title insurance company in the United States, the Law Property Assurance and Trust Society. The core idea was elegant. Before you buy, we research every document, deed, and lien in the historical record. We certify the title is clean. And if we miss something, if some defect in the past comes back to haunt you, we pay. Notice what that model was built around: the past. Title insurance was designed to protect against historical defects, mistakes in the paper trail, errors from before the closing date, unknown heirs, old liens that weren't discharged, forgeries, and a chain of deeds that went back to the 1920s. For nearly a century, this was enough. The threats were largely what they'd always been: paperwork errors, hidden heirs, municipal recording mistakes. But the world changed. And the policy language, written by an industry generating over $17 billion in annual premiums, largely did not. Here's something most homebuyers don't know. In the United States, title insurance is not truly optional for most purchases. If you're financing with a mortgage, your lender will require a lender's title insurance policy as a condition of the loan. Full stop, non-negotiable. What they'll often also sell you, though this one is technically optional, and few agents stress that distinction clearly, is an owner's title insurance policy. This is the policy that's supposed to protect you, the buyer. And so, at closing, most buyers sign and pay without reading. Because they're already signing 40 other documents, their agent tells them it's standard, and the title company has structured the whole experience to move fast. The industry has become extraordinarily good at being invisible. Think about that for a moment. You're paying, on average, between $1,000 and $3,500 for a one-time premium on a product most people couldn't explain if their lives depended on it. Unlike virtually every other insurance product, there are no monthly premiums. You pay once. The policy covers you for as long as you own the home. And unlike other insurance sectors, title insurance companies pay out remarkably little in claims. Roughly 3 to 5 cents per dollar of premium collected compared to 70 to 80 cents in health insurance. A portion of that goes to the real estate agents and mortgage brokers who steer you toward specific title companies, a practice called kickbacks in most industries, but wrapped here in regulatory language that keeps it just barely legal. The business model, in plain language, is collect large one-time fees, pay almost nothing in claims, and make sure the people selling houses recommend you. That system worked, or at least it didn't visibly fail, as long as the threats to your title remained the old-fashioned kind. Historical paperwork problems that a competent title search could catch. But starting in the 2000s and accelerating sharply through the 2020s, a new class of threats began to emerge. Threats that no title search, no matter how thorough, could prevent. Because these threats weren't buried in the past. They were being created in the present. Let's talk about the specific cracks, because this is where it gets real. Crack number 1, deed fraud in the digital age. In the last 5 years, deed fraud has exploded in the United States. The FBI and local law enforcement agencies have documented a stunning surge in cases where criminals, sometimes using stolen identities, sometimes using AI-generated documents, file fraudulent deeds transferring ownership of properties to themselves or shell companies. They target vacant land. They target properties with no mortgage because lenders aren't watching. They target properties belonging to elderly owners or recently deceased individuals. Here is the nightmare scenario. A fraudster files a fake deed in your name, sells your property to an unsuspecting buyer, and vanishes. The buyer gets a legitimate-looking title search. The search shows a recent deed transfer, which is real, just fraudulent. The title company may not catch it. You come home one day and someone else has purchased your house. Does your standard owner's title policy cover this? The answer depends on who did the deed. If you were defrauded, if someone forged your signature, most standard policies will cover the loss. But if the buyer was the victim, if they purchased from the fraudster and now face your claim, their coverage is less clear, often litigated, and dependent on specific policy language that most buyers have never read. Crack number 2, HOA superlines. This one shocks people every time. In over 20 states, homeowners associations have what are called super lien statutes, laws that allow unpaid HOA dues to take priority over even a first mortgage. If the previous owner of your home was delinquent on HOA fees and the HOA forecloses on that lien, they may be able to extinguish your mortgage and your ownership rights. Standard owners' title policies frequently exclude HOA-related claims entirely or cover only the specific dues owed at the time of your title search, not future assessments, not accumulated penalties, not the legal costs the HOA will pursue. The previous owner stops paying HOA dues. You don't know? You close. The HOA forecloses. You lose the home. Your title policy, silent. Crack number 3, zoning changes and government actions. Post-purchase. Your standard title policy almost universally excludes government actions taken after the policy date. This means if a municipality rezones your property, condemns it, discovers it was built on a regulated floodplain that wasn't properly disclosed, or exercises eminent domain, your title policy offers virtually nothing. In 2025 and 2026, as cities reclassify properties for transit corridors, climate resilience zones, and housing density mandates, this exclusion is no longer theoretical. It is happening to real homeowners in real cities right now. Crack number 4, mechanics liens filed after closing. A contractor who worked on the property before you bought it can, in many states, file a mechanics lien after your closing date, sometimes months later, if they were never paid. These are called hidden liens. Standard policies cover known liens at the time of closing, but often do not protect you if a lien is filed retroactively after you've already taken ownership. Crack number 5, artificial intelligence and the new fraud frontier. This one is where 2026 takes the threat to a completely new level. AI-generated documents, deeds, affidavits, power of attorney forms have become indistinguishable from legitimate instruments to the naked eye, and in many cases to automated document processing systems used by title companies. As AI tools proliferate, the ease of creating fraudulent property documents has dropped to near zero in terms of both cost and skill required. The title insurance industry's fraud detection infrastructure was built for human-scale forgery. It is not designed for machine-scale forgery. And the gap between threat and protection is widening by the month. Let's be concrete about what this looks like in human terms. In Houston, a woman named Patricia came home from a month-long trip to find new locks on her door and a note from new owners. A fraudster had filed a fake deed while her property sat vacant, sold it to an unwitting buyer, and disappeared. The legal battle lasted 3 years. Her standard title policy covered her eventual legal costs, but only after an 18-month fight with the insurer about coverage applicability. She slept in her sister's spare room for over a year. In Phoenix, a retired couple purchased a townhome in a community with an HOA. They were given a disclosure that showed zero delinquency at closing. 6 months later, they received notice that the HOA had initiated foreclosure proceedings based on 3 years of unpaid dues by the prior owner, dues that had been disputed, put into administrative limbo, and not reflected in the standard HOA certification provided at closing. Their title policy excluded the claim entirely. In Chicago, a developer purchased a commercial property, got a clean title search, and began construction, only to receive a mechanics lien filed 2 months after closing by a subcontractor who'd done demolition work for the previous owner and never been paid. The lien was for $140,000. The title insurance carrier denied the claim on the grounds that the lien arose from work completed before the policy date but filed after. These are not edge cases anymore. They are a category of loss that is growing. And the insurance product, most people believe, protects them from exactly these situations, routinely does not. At this point, you may be thinking, but wait, I bought the enhanced policy, the Alta Homeowners policy. Doesn't that cover more? Yes and no. The Alta Homeowners policy, introduced as an upgrade to the standard policy, does extend coverage to some post-policy risks, including certain types of forgery and some encroachment issues. For a roughly 10 to 20% higher premium, it's genuinely better, but here is what the enhanced policy still excludes in most forms: environmental hazards and government regulations, risks the buyer knew about or created, taxes and assessments accruing after the policy date, and crucially, in most versions, claims arising from artificial intelligence-facilitated fraud that exploits systemic document processing vulnerabilities. That last one isn't in the exclusions list because the industry hasn't written new language to address it. The enhanced policy was designed in an era before generative AI existed as a consumer product. The exclusions are artifacts of a legal and technological moment that has already passed. Meanwhile, a growing cottage industry of title monitoring services, companies that charge monthly fees to alert you if anyone files a document against your property, are not insurance. They alert you to fraud after it's happened. By then, the deed may already be filed, the sale may already be in progress, and you're in litigation. The alert system is not the protection. It's just a faster way to find out you need a lawyer. If this story feels familiar, that's because it is. This is the same structural failure we've seen in cybersecurity insurance, where policies written before ransomware existed are now being litigated because insurers claim ransomware attacks constitute acts of war, an exclusion written for nuclear conflict, now applied to software attacks. It's the same pattern we saw in flood insurance before Hurricane Katrina, where homeowners in New Orleans paid for policies they believed covered storm surge, only to discover the industry distinguished between wind damage and flood damage in ways that left them with almost nothing. In each case, the pattern is identical. A product is sold based on a risk environment that no longer exists. The policy language is not updated to reflect new threats. The industry profits from the asymmetry between what consumers believe they've purchased and what the contract actually says. The failure is invisible until the moment of crisis, which is exactly when it cannot be fixed. In 2026, title insurance is deep inside this pattern. The premiums are being collected at record rates as a hot property market drives millions of transactions. The claims environment is being transformed by AI fraud, super liens, and post-policy government actions. And the product being sold to most buyers has not meaningfully evolved to match the threat. So, what do you actually do with this? Takeaway 1. Read the exclusions before you close. Before your closing date, ask your title company to send you the actual policy document. Not the summary, not the marketing brochure, the full policy with all exclusions. Read Section 6. Read what is not covered. If your agent or title officer can't explain an exclusion clearly, that is a red flag, not a paperwork technicality. Takeaway 2. Ask specifically about post-policy coverage. Ask your title insurer directly. If a fraudulent deed is filed on my property after closing, am I covered? Ask about mechanics liens filed after closing. Ask about HOA superlines in your state. Get the answers in writing. If they say yes to everything, ask them to show you the policy language that supports that. Coverage that cannot be pointed to in a document does not exist. Takeaway. 3. Consider a title monitoring service, but know its limits. Title monitoring is not a substitute for proper insurance coverage, but it is a useful early warning system. Set one up. Many county recorders now offer free property alert services that notify you when any document is filed against your address. This doesn't prevent fraud, but it dramatically shortens the response window, which matters enormously in fraud recovery. Here's the open question I want to leave you with. The title insurance industry is generating roughly $17 to $20 billion in annual premiums in the United States. Its lobbying presence in state legislatures is substantial. Its relationships with real estate professionals who steer buyers toward specific companies are embedded in the transaction infrastructure. The incentive to update policy language, to extend genuine coverage to the new class of threats, is low, because doing so would require paying out far more in claims. The incentive to sell the appearance of comprehensive protection at a one-time premium that feels routine at a closing table already full of large numbers is high. The question isn't whether your title insurance company is acting in bad faith. Most of these companies are operating exactly within the law. The question is whether the law and the product it enables is still serving the people it was designed to protect. And based on what's happening in courtrooms and living rooms across America right now, that answer is looking increasingly uncertain. If this video made you think differently about a purchase you've already made, or one you're about to make, share it with someone who needs to hear it. Not everyone has a real estate attorney in the family. Sometimes the most valuable thing you can do is make sure the right information reaches the right person at the right time. Drop a comment below if you've had a title claim experience, good or bad.